Welcome to the Investment Society. Welcome to our first ever cryptocurrency masterclass right now. Sponsors, so today our sponsor is OKEX, and they are sponsoring Lecture 1. So, as you've probably gathered, they're giving away Bitcoins for people that are in the audience here. You get the priority, £1,000 worth, so it's going to be divided amongst all of you. So for the first lecture for you guys, for the first 200 in-person attendees. So just to sort of explain again, this is the first course that's ever been done on cryptocurrency. No other university has really done it like this. And it's also the first Bitcoin giveaway of any kind in any educational institution. This is quite exciting times that we haven't seen before, and certainly we're going to be at the front of this sort of education for the next few weeks.
Hey guys, could you hear me? Okay, I think you could. Right, so welcome. This is going to be the first lecture of the 4 lectures we're going to be hosting, named Introduction to Cryptocurrencies. So I know a lot of you guys have been investing in cryptocurrencies or trading, and there are some of you guys who haven't been in the space yet. Just curious, out of all of you guys, does anyone know any coin rather than Bitcoin and Ethereum? If you could put your hand up, that would be great. That's quite a lot of people. Okay, you guys know a lot about cryptocurrency already. So a quick story. So I joined a startup this year, around November time. Traditional finance startup that's trying to bridge into the DeFi space. And then the boss only knows 2 coins, which is just Bitcoin and Ethereum. So, you know, traditional finance people, when they get into the space, Bitcoin, Ethereum is their go-to station for, you know, entering cryptocurrency. But it's much more than that. And that's what we're trying to share today. And this event is kindly sponsored by OKEX, one of the leading exchange globally. They've asked us to take a photo, so yeah. Right, so I'm Sean. I'm a third-year bioengineering student. I've been playing with crypto since 2018, and I'm also part of the QT Capital Group. I don't actually hold any Bitcoins myself. You know, many exchanges are gifting Bitcoins out for the same reason as I see Bitcoins. They are great value stores, but there are more applications than just Bitcoins. And then for our course outline, this course, the first one is just going to be talking about some of the general landscapes, the applications, and the history of cryptocurrency. So hopefully by the end of today, you'll be able to get a basic understanding of what blockchain is, what cryptocurrency is, and what you could do with cryptocurrencies. Why is it essential to have cryptocurrency in certain applications? Then the second lecture, we're going to talk about DeFi, Metaverse, and NFT. So you guys know that Facebook's rebranded their name to Meta, which is showing that they're trying to shift into the Metaverse. But Metaverse was actually an idea that's originated currency because it was an idea to use cryptocurrency in the VR space to pay for virtual items. And then the third lecture, we're going to be talking about some ways to value cryptocurrency. So that's more about investment and trading. I think, you know, if you're like in the investment society, you might be more interested in that. And then the fourth lecture, which is going to be next year, that's going to be a special event. We're going to invite some people who's working in the industry to talk about the career opportunities in here. But just to give you like a rough head, if you work in cryptocurrency as a trader, you make more than the traders in investment banks. And work as a Solidity developer, which is Ethereum developer, your salary would be on par with Facebook and all of the big names. So exciting opportunities. And just frankly speaking, the supply up with the demand. So yeah, that's pretty much what I'm going to say before Emran comes on stage. So I'll hand over to Emran.
Hey guys. So yeah, just a little bit about me. I'm a second-year mechanical engineering student. I've been in the space since 2018, but for the first, I'd say 2 years, I was purely a spectator, and that's because my dad was into it, and I just thought, yeah, this guy's getting scams at some point. And then I kind of just randomly fell into a rabbit hole after a certain period of time, and yeah, so here I am today standing in front of you. I play with cryptos at QT Capital, so I'm a senior analyst, and I call myself what is known as a altcoin degenerate, which basically means I only hold altcoins, and I think Bitcoin is a bit controversial, but I think Bitcoin is boomer technology. And yeah, I'm also a new profit rotator, so I can never be in cash. I'm always moving from one position to another. So yeah, that's a bit about me. So I think I'll start off talking about the brief history of cryptocurrencies and cryptography in general, which is the technology behind the design of cryptocurrencies. So in the 1980s, there were a group of people known as the cypherpunks, and they were sort of seen as like these hip, smart, young individuals who had wild dreams. And they sort of, as the whole internet world was rising and computers were getting, better with Moore's law and everything, they had this vision for the world, a borderless virtual world. And you could say they're quite ahead of their time. Like Sean said, Facebook just rebranded to the metaverse. And they were basically referring to the metaverse without actually calling it that. And so for the next couple of decades, there were large amounts of research happening in the cryptography space and mathematics in general. And this contributed to a lot of developments in cryptography and the technology behind what is known today as cryptocurrencies. And so in 1997, a group of students at MIT, they discovered or they invented this mathematical system. And they were quite amazed by it. And what the mathematical system did was encrypt messages through the software they designed. And what happened is the National Security Agency in America shut them down straight away. And this is because of they thought that encrypting messages was a security threat because the government couldn't have surveillance over what people were saying and stuff like that. And so yeah, that was one of the first ever controversial events in encryption, basically. Well, there was obviously in the world wars they had their own, but this was the first through code. And so the first cryptocurrency, which was called eCash, was invented by a guy called David Chaum in 1983. And then 5 years down the line, BitGold, which was the first anonymous cryptocurrency, so the people who created it weren't known. That was created in 1998, and it utilized a proof of work mechanism, which is a consensus protocol, and I'll talk a bit about that later. And so yeah, Bitcoin wasn't actually the first cryptocurrency to ever be created. So Satoshi Nakamoto, the creator of Bitcoin, he wrote the Bitcoin white paper in 2008, and in 2009 is when the first launch of Bitcoin happened. And so proof of work, which I mentioned was a consensus protocol, was the first ever consensus protocol that was invented. And then in 2011, a project called Peercoin, they launched with a proof of stake consensus protocol. And fast forward to today, you have thousands and thousands and thousands of projects that have different technologies that use different data structures and algorithms, implement different types of graph theory. And it's led to a lot of wide-scale institutional adoption from banks, from venture capitalists, from companies like Facebook, and even countries now. So in 2021, Cuba and El Salvador, they announced that they will now accept Bitcoin as legal tender, which basically means a sort of a medium of exchange. And actually recently, El Salvador, the president, he announced that he's launching his own Bitcoin city. I don't actually fully know what that means, but I know that somehow it's going to be fully run on Bitcoin through geothermal energy. They're going to build the city on the bottom of a volcano, I believe. It'll be interesting to see how that develops. So I'll put a timeline on the slide, which you can probably explore more, in a bit more detail later on. And it's just a lot of developments in the cryptography space, such as papers on things like elliptic curves and smart contracts and hash algorithms. And so yeah, just some important people you might want to know. Nick Szabo, he's known as the father of smart contracts. And if anyone doesn't know what a smart contract is, it's just a contract that has been coded. So there's no need for intermediary person or organization to facilitate the execution of a contract. And then there's Stuart Haber, who's the father of the blockchain. and Satoshi Nakamoto, who is father of Bitcoin. He wrote the white paper. And no one actually knows who he is yet, although there are a lot of conspiracy theories, which I have a lot of fun reading. Okay, the next one. So what is a blockchain? My simple definition of what a blockchain is a blockchain is a database that stores encrypted blocks of data and then chains them together in a chronological single source of truth for the data. I know that might be a bit confusing, so I found a video that explains it quite well. And yeah, I'll just play that for you guys. Hopefully that gives you a better idea of what a blockchain is. Is the sound working for that?
Many people think of blockchain as the technology that powers Bitcoin. While this was its original purpose, blockchain is still on board. By the sound of the word, there's not just one blockchain. There's blockchain, the shorthand for Everyone. Some people have access. I got my input, but I think it was working out. Well, people
All right, yeah, so that was just a high-level overview of what blockchains in general are. Hope it helped in clarifying what it is. Yeah. Right, okay, so I've talked about what a blockchain is. I haven't really explained what a cryptocurrency is. And a cryptocurrency is basically a digital or virtual currency that is secured by cryptography with a decentralized network design. Although that doesn't hold true all the time, some cryptocurrencies have elements of decentralization in them and some purely decentralized. It really depends on the project we're talking about. But if we talk about Bitcoin, for example, then most people agree that it's highly decentralized. And throughout the history of time, our use of money has changed. So in the olden days, we used to barter, we used to exchange goods with each other depending on if there was a coincidence of two wants and needs. And then we kind of evolved to like coins because we found metal valuable. And then we moved towards paper, card, and then you can see now that in the current world we're sort of transitioning towards the digital, sorry. And so yeah, I believe cryptocurrency has a part to play in that in the future. And so I think I'd explore some differences between traditional fiat money, which we currently use, and cryptocurrency. Cryptocurrencies are purely digital, whereas fiat money is partially digital and partially, well, you can use paper and coins, I guess, yeah. And so fiat money has an unlimited supply. It's controlled by governments and central banks, whereas cryptocurrencies, although this doesn't hold true for every project, but a lot of cryptocurrencies have programmed supply, so no one can change it. And even the ones that do get changed, they never get changed as much as how much fiat money gets changed. So for example, if we're talking about the US dollar, 40% of the current circulating dollars were printed in 2021 alone. And yeah, it's quite concerning for me. And if you even look at like the Turkish lira, for example, in the past week even, it's gone down pretty bad. And that's as a result of like the political instability in the country. Fiat money is highly centralized, and like the video mentioned, cryptocurrencies tend to be highly decentralized. And the value of fiat money is dependent on a lot of different factors, such as like regulation and the general macro outlook of the whole world. Whereas cryptocurrency is generally more of a free market. It's just supply and demand. And so yeah, I touched on a bit about the consensus protocols. You might have heard me mention proof of work and proof of stake. But what exactly is a consensus protocol? So a consensus protocol is some form of protocol that prevents a single entity from taking control of the whole network. And it's designed in such a way that consensus is achieved by design, and all participating nodes in the network must agree on every change to the blockchain. And what this does is it allows for a trustless system. So you don't have to trust a third party or intermediary. And in that way, a single entity is prevented from distorting the truth, and it basically solves a problem called the Byzantine general problem. And you can look up more about that if you want. There are different types of protocols which have their own pros and cons, and you can explore that in your own time, and we might even do a presentation in a bit more detail about that later on. For example, like I mentioned, Bitcoin uses proof of work. There are other consensus protocols that use proof of stake, so Ethereum currently uses proof of work, but they're planning to transition into proof of stake, and they have their reasons, such as the use of energy, and I think that's their main concern. And proof of history, which is something that Solana used, although they've combined with proof of stake as well. And there's also like direct acyclic graph technology, but that's quite a novel. It's a novel technology when it comes to cryptocurrencies. An example of a project that used that technology would be Hathor Network. It's not really known, but yeah. You can divide cryptocurrencies into two different sections. One would be a coin and one would be a token. Coins are cryptocurrencies that are native to its own blockchain. So for example, Bitcoin, Ethereum, Avalanche, and legendary Dogecoin. And tokens are sort of cryptocurrencies that aren't native to their own blockchain. So they're built on top of another network. And DeFi, so decentralized finance, which we'll touch on a bit more in the next session, comes into that category. So coins like Compound, Uniswap, and then oracles such as Link, they are not, they're sort of chain agnostic. They can sit on multiple chains. So it's much harder to come up with innovative coins because you need to have extensive knowledge in data structures and algorithms and graph theory and optimizing for all of that stuff. And even in terms of valuing a coin is much harder than valuing a token, because a token is literally just a decentralized application that's built on top of a blockchain. So I'll hand it over to Sean now.
Yep, so Imran mentioned about the whole idea about coin and token. Just to kind of expand on that, you could think of a coin as a country, basically like America, China, or Japan. And then a token is basically a city that you're building in the country, right? So in terms of valuations, usually coins are valued much higher than the tokens due to the sense. And usually each city, say for example, I'm from China myself, so Beijing is kind of like the capital, and then Shanghai will be the center for economy. Each of the tokens have their own utilities, and they've got different valuations based on that too. And then from there, we're going to talk about decentralized applications, which is essentially what tokens are. So this is where I think cryptocurrencies really get interesting, because people think that cryptocurrency is just something you buy today, tomorrow you get rich, or you get broke, right? Not necessarily that. There are many things you could do with cryptocurrencies. Say, for example, one of the most prominent example would be DeFi. So DeFi is essentially decentralized finance. We've got banking now, so you could deposit your money there and you earn like 0.2% annual returns, which is really poor, right? And then someone could borrow from it, and then they'll be paying 0.5% on their annual kind of money they've borrowed. But then you see someone's taking the middle cut here, a 0.3% there. And DeFi essentially is kind of taking out the middleman there. You could literally say, hey, I'm lending you for, say, 10%, and then this guy might borrow it for like 10.05%. The only cut that the network is taking is to maintain the network's usage there. So it's a much smaller cut than the traditional banking, because banks could be kind of, they don't have to be very transparent about what they do at the back. But DeFi, everything's written in code, and you could find every single lines of code online. Therefore, it's quite transparent. And then there's your decentralized exchanges. So centralized exchanges will be something like London Stock Exchange or New York Stock Exchange. So these are like the centralized places. You basically supply the stocks there, and then someone will buy from the centralized exchanges. Decentralized exchanges have the same idea, but rather it's just more transparent, just like DeFi, essentially. And then you have your NFTs. So this is something that's quite special. We'll touch on that in the next slide. And then you've got your gaming and metaverse. So in metaverse, everything is virtual, right? So you've got your virtual house, virtual car, and then you've got, say, I don't know, a painting your house, or everything's virtual, basically. And all of these could be bought and paid in cryptocurrencies. And that's actually where the idea of metaverse came in at first. And then you've got what's called DAO, which is decentralized autonomous organizations. So I'm not sure if you guys know a protocol called Constitution DAO. So basically, that's quite political here, but basically, America is selling some of their rights to, I think, decide on some of the politics. And then Constitution DAO is basically 18,000 different users on the internet. They put their cryptos into this fund to kind of bid for the right to change the politics. So essentially, you get the right to say for what sort of politics you need in the actual world, and these are essentially what DAOs are. But DAO right now, most of it is on decentralized applications where you basically, the users get to vote what they want in the decentralized applications. And then you've got your decentralized media. So say, for example, YouTube and Spotify, the problem with these companies is they've taken a huge cut from the artists or creators. So I used to do YouTubing myself, and then the advertisement fees that you get from it is only 55% of what Google pays YouTube, or what other companies pays YouTube. And then for Spotify, if you're an artist there, you only get 30% of what people actually pay. So is that fair? I don't think it's fair, right? I don't think it should be the company that's deciding how much the artist is getting paid, but rather the artists themselves, they decide how much I want to get paid, right? So some of the applications like Audius, they've teamed up with TikTok recently, and then their artist gets paid roughly 80 or 90% depending on what the artist sets to, but basically a much higher much higher takeaway from these kind of applications than using Spotify. And then you've got your oracles and data. So if you guys study computer science by chance, this is more on the data side. So blockchain has a problem. It can't really interact with the outside world, and oracles and data kind of solves that problem. And then we're going to talk about one special type of token, which is NFTs. So recently, these are quite hot, right? So you see this middle one. Do you guys know how much this is worth? Anyone wants to have a guess? Yeah? 500 million? Probably not that much, but you're kind of close in a sense, yeah? Anyone else? Yeah? 16. Yeah, very close. Actually, the market price is around that right now, if it's correct. But last time that it was auctioned, it was sold for $11 million. Just a pixel profile that you can have on your Twitter, that's worth $11 million. So is it worth it? I don't know. You make the call yourself, right? But people say this is basically a new sort of thing that you can trade on, a new sort of thing that you could collect and have in your home, right? But these things are very unique in a way because you can't exchange them with one another with the same sort of value. And what does that mean? Say, for example, you got a Bitcoin in 2009, and then I got a Bitcoin today. They are both worth roughly $60,000. But then say, for example, if I've got this CryptoPunk, this is called CryptoPunk, by the way. If I get this CryptoPunk back in the 2020, and then you get a similar one from the same family of NFTs, looks basically the same, that one might worth very different, just because they are not exchangeable between each other. There's a lot of details to go into there, but we will dive deeper into that in the next session. So why do you want to invest in cryptocurrency? Right? I mean, just on a personal level, cryptocurrency is what helped me to pay for part of my tuitions. I'm an international student, so I pay like 30-something K per year. Quite expensive, and I don't want to put too much pressure on my family, so I took out some of the money from my cryptocurrency to pay for the tuitions, and it's very lucrative if you are like an early kind of participant in many of the protocols or many of the schemes. And it takes years for people to adapt to these trends. Internet took about 10 years for 30% of the population to get used to it. Cryptocurrency, I would say it's about the same speed for people to get used to it. So, before you realize it becomes too popular, that's the best chance to get into the industry. Because once everyone knows, oh, crypto makes a lot of money, then everyone's going to be coming in. So, the alpha decays in a sense. And then it's very early in the stage. We've got insane growth potential and a lot of things that we could do. old money market is sitting at $86.5 trillion. The stock market is sitting at $67.5 trillion. Does anyone know the market cap for all of the cryptocurrency right now? Yeah?
2.55 trillion.
Yeah, roughly that. So at its peak is around like 3 billion or something. So that's, around 5% of the total stock markets. But for stock markets, they've got regulations and they've got all sorts of constraints. It has to be a company to be listed on the stock market, right? But for cryptocurrencies, you don't really have to be a company. You can just be a tool of payment or any sort of meme coin like Doge listed on the market. So there's a lot of things that you could do in crypto. And actually the startup that I'm working for right now, what we are doing is allowing people to use crypto to invest in stock markets. So before you can't use Bitcoin to pay for Tesla stocks, but now you can. And then there's a whole bunch of regulation problem with it because some of the investment bankers, they can't invest in stocks, but with our protocol, with our platform, they could buy crypto first and then invest in stock, which is the same thing. But then that, that kind of comes into the regulatory, concerns and things, but that's basically where all the alpha lies. Before the regulation comes on, that's where most of the alphas are, right? So we're going to be talking about markets mostly for this kind of lecture. So we're going to be talking about 3 types of markets that you could participate in, the primary, secondary, and the mining markets. I'm pretty sure you guys are quite familiar with mining. So that's basically you either get a machine that has a very good GPU and you mine for some sort of cryptocurrency, or you could also do what's called proof of stake mining nowadays, or liquidity mining nowadays. But those are quite technical to get into. And then secondary markets, that's where most of the traders lies in. So you could do spot trading, leverage, perpetual options, and futures. So leverage, options, and futures, they're exactly the same as the traditional stock markets. Perpetual and spot is a bit different, and we'll touch on that later. Primary market, this is where things get really interesting. So could you imagine that you start a company and then it will be publicly listed within 2 years? That's very hard, right? But one of my friends at LSE, he did something like this year. It's called Tempest of Finance. They literally formed a group together in May this year. And then last Thursday, they basically got publicly listed. And then now they're worth about 120 million in market cap. It's not a huge company, right? But it only took them half a year to get publicly listed. So this is one of the interesting things about crypto. Since everything is pretty much decentralized, no one gets to say whether you get listed or not. Besides, if you want to list on something like Binance, which they have a whole kind of process to scan you through before you can get listed. But you have your ICO, IDO, and ISO, and we'll talk about these in the next slide here. So primary market, this is where your private sales happen. Same as you IPO in the stock market, some people, they invest early or they buy around the IPO time and then they get cheaper stocks than the market price. And then for ICO and IDO, that's the same thing. So that's when, say, a protocol decides, hey, I'm going to issue a token to the market and you could participate at this sort of price. And that's what ICO and IDO is. And then usually, early participants, they take bigger risks, right? Because they don't know how the company will perform in 2 years' time, 5 years' time, or 10 years' time. But giving you some rough examples, Solana, when they did their ICO, I think it was about a few cents, but now they're roughly worth $200, I think. So if you think about the returns there, that's probably a few thousand X, right? So that's a huge return. You can't do the same in stock markets, at least not within 1 year of launching, right? And then for ISPO, that's something very unique to itself. It's called Initial Stake Pool Offering. So we've mentioned about proof of stake. You could stake your coins into a pool and then you get staking rewards. And then ISPO is essentially a form of the reward. That's been done in Cardano. Cardano is the 3rd biggest cryptocurrency in the world. They've launched basically the smart contracts, I think, in September, late September. And then many smart contract developers immigrated to that platform to develop applications there. So you could think about Ethereum, Cardano, Solana, AVAX, all these Google Store and Apple Store and all sorts of, Blueberry, BlackBerry stores. Basically, they sell these applications. And then these applications are what makes the ecosystem exciting, basically. So, if you want to be in the primary market, I highly suggest you do a lot of research before you invest in any of those. Because, say, for example, Tempest of Finance, the company that my friend works for, they've only been doing this for half a year. So there's a lot of uncertainty in what they can do and what they can deliver. But if you're right on your investments, this could just be your key to financial freedom, of course. But a lot of the ICO IDOs, they do fail. So be very careful if you want to invest in the primary market. And then for the secondary market, this is where I think most of the investors will be quite familiar with at this point. Spot trading is just like buying and selling stocks without leverage. So that's just a fancy way of saying I'm going to buy a crypto and sell a crypto. And then leverage trading, futures and options, they're the same as in the stock markets. Perpetual is something that's very unique to cryptocurrencies. So futures, they have a delivery date. Say, for example, you buy the oil contract that's going to be expiring in December. So then if you don't sell your contract by the end of it, you're going to have the physical holdings of it. But cryptocurrencies, they are all virtual, right? So you can't really deliver these things unless you want to deliver that to someone's wallet, which can be done by the futures contract. But some guy basically came up with the idea of saying, hey, we could create a future that never has an expiry date, which is where perpetual trading comes from. And you could get leverages up to 125x, which if you do the calculation here, if the coin goes down by 0.7%, you'll be fully liquidated. But again, if the coin goes up by 0.7%, you double your position. So some people, they're really crazy, right? They go into Bitcoin trading and then they do 125x. And then Bitcoin, say Tesla or Elon Musk say, oh, we're going to accept Bitcoin payment now. And then the coin pops 20%. You do your calculations here, but basically you make a 25 times return in probably 10 minutes, which is crazy, right? That can't be done in the stock market. And then mining, needless to say, I think since we are all STEM students here, a lot of you guys know how to do mining already. Basically, get a CPU, get a GPU, and you probably don't even need a CPU nowadays for mining. But basically, set up a mining account, and you could basically mine the coins from all these sort of different cryptocurrency protocols, whether that's Bitcoin, Ethereum, and nowadays Raven's another very popular one. But the problem with it is you need a lot of capital to get started on these, right? If you want to buy GPU nowadays, it's quite expensive, and also your returns are quite low from these. In terms of low, it's actually not that low. If you do it properly, roughly 180% of return is usually like what miners get during a normal market. But during a bear market, you might lose money. You need electricity and your GPU wears out and so on and so forth. And the amount of Bitcoin that you mine might not compensate for those. So mining used to be a very hot industry, but nowadays it's getting less popular just because of the halving problem in Bitcoin. And halving basically means every 4 years, the amount of Bitcoin that's contained in each block of the Bitcoin network halves. So you get less reward as a miner. Now, let's talk about spot trading. We're not going to be talking about leverage trading because that's very dangerous, right? And we don't like risks, do we? I like risks myself, but for most people, this is probably where you should get started with cryptocurrency. You could do this through a centralized exchange, so OKEX, which is, again, a leading global exchange, or Binance, Kraken, or Coinbase. You could buy coins there, just like you buy your stocks, but of course, do your research before you go into any of the positions. Or you could do it through decentralized exchanges. Decentralized exchanges, they tend to have a higher fee than the centralized exchanges. Then why do you still want to use decentralized exchanges? Well, that's a question. That's a good question, but many of the decentralized exchanges, they provide other things rather than just buying and selling. You could also do what's called liquidity farming or staking there, where you get extra reward, and that's coming to the space of DeFi, which we're going to dive deeper in next week. There are many interesting different projects in DeFi right now. And you could basically stake your stablecoin for 20% return per year, which is more than what you get on SPY 500 on an annual basis if you look at the past 20 years, right? And there's no risks. Basically no risks unless the code gets broken down, which means they get hacked. So very interesting space. And investing in crypto and stocks are very different, in my opinion. you could use a lot of metrics in stocks, right? Like PE ratio, market cap, and DCF models, F2F, whatever. If you're like doing investment banking, you should be quite familiar with that. But in crypto, you don't use those metrics. You have what's called on-chain data. So these are the data that's generated from the blockchain, and they contain a lot of useful informations. And we're going to be talking about those in our third lecture, how to look at them and how to use them. But there are a few general things you could take away from here if you really want to, invest today, say, for example. The biggest thing that you could take here is market cap. So market cap is very important. Dogecoin has a similar market cap to, I think, Binance Coin, Binance Smart Coin at a point before. I really don't like Dogecoin myself because it's such a meme coin, but at a point it was very popular. And its price is very cheap, right? It's only like a few cents or 20, 30 cents, 70 cents at its peak. And Dogecoin is very similar to Litecoin and Bitcoin in terms of its mechanism, but the price of each single coin is very different. And that's because their model is designed to be what's called inflationary. So each year you get so many more Dogecoin coming into the market, which means the supply to the market increases every day, right? So if the demand can't keep up, then naturally the price drives downwards. But then for Bitcoin, you have a limit of how much there is in the market, which is 21 million. So if the demand increases and the supply doesn't change, which frankly speaking is actually decreasing at this point because many of the miners or many of the people holding Bitcoin, they're not selling them. They're holding it in what's called cold storage. So your liquidity actually decreases in this point, and then the price drives up. And this is why people say Bitcoin is a good hedge against inflation and so on and so forth. Ethereum is activating something very similar because before they were also inflationary by design. But then I think in August by the London hard fork, which I'm not sure if you guys are familiar with, but that's kind of like the improvement protocol you have on decentralized applications, which means that people vote on what sort of improvement they want to the product. And then Ethereum responded, yeah, we could do that. We could change our model from inflationary to something else, basically. And then that introduced a buying pressure in the market. And then that basically pushed the Ethereum price up to where we're seeing it today. But at the same time, if you guys use Ethereum blockchain, you know the high gas fee on it, which is why there's a multi-chain culture slowly evolving at this stage. Many other blockchains, they're much cheaper to use and much faster than Ethereum. And of course, diversification is highly recommended. You see those crazy stories where people make like huge amount of returns when they go all in one coin, like Dogecoin. And at a point, myself was like that. And I've made some good returns when I was very lucky because I don't even know what a coin was. I just saw the name. Oh, SafeMoon. It looks very good to me, right? And then basically a very good coin. Everyone's saying buy it. So then I just pumped all of my money into it. And then I sold it the next morning. I woke up because I realized, I don't really know what I'm holding. So it doesn't give me a peace of mind. But that's very dangerous to do in crypto. Some coins, they have what's called a rug and pull scheme. So basically, you put your money in, and then you can't sell it anymore. So do you guys know the Squid token? Yeah. Squid Games, yeah. So that one, you can invest in it, but you can't sell, right? So then that basically means all of the money you put in is taken out by the developers of this kind of protocol, let's say. And then other coins, they might not perform as well because everything is not so transparent. So be very careful on that. Do researches, watch some YouTube videos on how the coin works, and just read more about their white paper, because white paper contains every single piece of information that's needed for you to make your judgment about whether a coin is good or not. And then in the next session, we're going to be talking about NFT and Metaverse, and then also talking about DeFi. We'll be naming a few DeFi projects that might be looking into. The stablecoin project I was mentioning just now, you can get 20% return without risks, which is really attractive, but there's much more than just those. And we'll be inviting some people from the London Blockchain Labs to talk with us. Some of them work in the DeFi space. Some of them work for some metaverse company. So the next one will be even more exciting than this one. And then now it's a special time for our courtesies to our sponsor, OKEX.
Courtesy to our sponsor, OKEX is the leading global exchange on all centralized activities of trading. And you could have a look at the next slide. We're gonna scan the QR code here, copy paste the address into Chrome browser, and you could claim your free Bitcoin. It's also got services such as finance, which is basically deposits and saving, but generates you much higher yields than the general banking system. And it's also got perpetual swap trading for those of you who are interested in leverage tradings. So it's all in all a very good platform to use. And I wish you guys best of luck in the future.
Their Twitter is up there if you want to follow. They've got a lot of alpha leaks there, which means they give you a lot of information about what kind of project is good there. And then if you want to join, you could use the referral code here to get 20% discount on your trading fees. If you want to take a photo, that up to you. But even if you don't want to use the referral code, on the next slide, you're still going to get some free Bitcoin. So
if you'd like to give me a round of applause for that. Well done. Excellent. So what we're going to do, I'm going to cut the stream now from the Teams channel, and we're going to put up the QR code because we said in-person attendees get the Bitcoin. And once you guys all got it, we'll see how many are left, and then we'll give it to the Teams guys. If you are on the Teams call and you can still hear me, you're very unlucky. You should have come. So there you go. There's the QR code. Lots of phones. Scan it. There's Imran as well. Claim your Bitcoin. Sean, do you want to explain to them how it works? There's been a bit of a...
Yeah, sure. Right. So you can see the instructions on the left side. So you scan your QR code, which is in Chinese because OKEX used to be a Chinese exchange. And then you copy-paste the address you get into your Chrome browser, enter your phone number and get an activation code. And then if you haven't registered an account yet, then this should lead you to registering one. And then once you download the OKEX app, you could claim your BTC